So it says, and I read, so that is question 2 in our handout, question 2 in the handout, and it says, the following financial statements relates to H Limited and investment companies. Its investment companies. Its investment companies S Limited, A Limited, and J Limited for the year ended 30th April 2012. So we have the income statement for H, S, A, and J, as you can be able to see. Then statement of financial position, also as you are able to see there. Then let's go to the additional information. Additional information. They are saying that 1, H Limited acquired the investment in other companies as follows. So company being acquired, SAJ, dates of acquisitions, we have 1st May 2008, 1st May 2009, 1st May 2010. Shareholdings, so shareholdings 80% subsidiary, 40% associates, 50% joint ventures. Cost of purchase, so cost of purchase is the purchase consideration which you will use in goodwill determination. Then we have revaluation, then we have retained earnings or retained profits. H Limited also invested in a half of the 10% loan stock in S Limited. They invested in a half of the loan stock. So fine. The fair value of the non-controlling interest in S Limited was 75 million on 1st May 2008. So already I've been given fair value of minority. There is nothing I'm waiting for. Allow me to calculate goodwill at that particular stage. There is nothing we are waiting for. Let's calculate goodwill immediately. So that is our working one, goodwill. So let's calculate goodwill. So we have S, A, J. S, A, J. I want us to calculate goodwill there very fast. So you take purchase consideration. So purchase consideration. Purchase consideration. Purchase consideration note 1, you are able to see the cost of purchase. So cost of purchase is 300, 200, and this is 250. I hope you can be able to see those figures. Then fair value of non-controlling interest in note 2, just how much? In note 2, there is the fair value of non-controlling interest. So you say fair value of NCI. Fair value of NCI. Of course, NCI is in S. They will say 75. There. So total is 375. This is 200. This is 250. Call it A. There. Call it A there. Then we want to get the net assets. Net assets acquired. We want to get the net assets acquired. So net assets acquired, check under equity. Under equity, we have ordinary share capital. So ordinary share capital for SAJ. Check for SAJ. So ordinary share capital, SAJ, we have 50-50, 100. 50-50, 100. Share premium, SAJ, we have 50-50 across. So this is, no, sorry, this is 200, check well. 200, 200, 200, 200. 200 across. Share premium is the one which is 50-50, 100. You check keenly. Revaluation and retained earnings, use the ones on the date of acquisition. Check additional information number 1. So revaluation on the date of acquisition, check note 1. So note 1, you will see revaluation of 20, 15, 20. Then retained earnings, still in note 1, on the date of acquisition, retained earnings is 85, 150, then we have 120. Therefore, you add so can you add those totals? Thomas, handout question 2. So add and give me the answers. Add the net assets. So net assets, this is 200 plus 70 plus 85. This is 355. Then this is 250. That is 165. This is 415. Then this is 300. This is 140. This is 440. Then now you take your percentages, the percentages acquired. So the percentages in S, find parent acquired 80%. 80% in S, but now net assets we will not take 80 because it is full method. Full method means we have added minority. When you add parent plus minority, it gets to 100. So here, I'll say full, comma, A 40, J 50. This one I'm taking full because minority has been added. So you don't apportion the net assets. So this is 355. 40% of 415. 40% of 415 is 166. 50% of 440 is 220. Then those brackets, you call them B. Therefore, goodwill will be A minus B. Goodwill will be A minus B. We should now take this minus this. So 375 minus 355, that is 20. 200 minus 166 is 34. 250 minus 220 is 30. So leave it hanging, just in case we get impairment along the way, we will adjust. So we have computed goodwill using that note 1. Alright, so let's continue. Additional information number. No, I think just a minute. Read note 5 kidogo. We have to jump. Let's jump kidogo to note number 5. Check additional information number 5. Additional information number 5. All the goodwill of the three companies in which H has invested are estimated to be impaired by what percentage? 25%. So impairment loss, so that I finish this issue. Impairment loss, 25%. So calculate 25% in each case. So 20 by 25, this is 5, this is 8.5, this is 7.5. And total impairment will be 5 plus 8.5 plus 7.5. Total impairment is 21. It will affect our profit account, the total impairment. So goodwill is one of the things which can waste time. So calculating it is it's a plus to us. A plus to us. I hope everyone is there. I want to go to note number 3. I want us to go to note number 3. Note number 3 says, during the year, H Limited sold goods to S and A as follows. Sold goods to H and S. So S and A, there is 150, then there is 30, 20, then there is 50, they're not available. So what they mean, whoever typed for me there's something they never captured, I want you to capture for those who printed. They are 150, this was selling price. Those are the selling price of the stock. 30-20 is the profit margin. Is the profit margin. Then 50, that place of 50 not available, is percentage in stock. So percentage in stock means what was not sold. So, yes. So this one here should help you to calculate the unrealized what? Profits, UPI. To get the unrealized profits, you will take the profit margin. Don't bother with the associates, kindly. Don't be bothered with the associates. So the one for associate is quite irrelevant. We don't need it. You concentrate with the subsidiary. So you take profit margin, which is 30%, times the goods which were not sold. So they have said the percentage in stock is 50%. So 50% of the 100 times the profit margin. Therefore, UPI unrealized profit is equals to percentage in stock. So percentage in stock is 50% of the selling price, which is 100, times the profit margin, which is 30%. That one is likely to give you 50% of this is 50 times 30%, that is 15. So that is it. That is our unrealized profits. Let's go to note number 4. Note number 4 says, and I read, on 1st May 2010, H sold S an item of plant for 200, reporting a profit of 25% profit of the initial cost of the plant. The group charges depreciation at 20% per annum on cost of the plant. Sale of PP, that one comes up with what is called UPFA, and realized profit on fixed assets. That is what they are checking. So let's calculate that. So UPFA using note number 4, they say they sold it at 25% of the initial cost. That is markup. We don't work with markup, rather we work with what? Margin. So if markup is 25%, margin will be 25 over 125 times the sale value of that PPE. The sale value is 200. So 25 over 125 is a fifth. A fifth of 200 is 40. Then these people were charging excess depreciation every year. So excess depreciation will be 40, because what brings excess is the UPFA, the unrealized profit. So to get the excess amount, you take the UPFA times the depreciation rate, and depreciation rate is 20%. Therefore, there is an excess amount of how much? 8. So every year they are charging excess by 8. Correct? Let's go to note number 5. All the goodwill are impaired. That one we have captured, and even we have computed impairment loss. So that is done. Number 6, included in trade and other receivables and trade and other payables are the following outstanding balances. So those are the what we call intergroup debts and balances, which will be effected out from receivables and payables. So due from S to H 50, due from A to H 10, due from H to J 40. Anything touching A and J, ignore, because they are not going to be eliminated. A and J are considered to be not to be part of the nuclear family, and therefore the one which will be eliminated is how much? 50. So the 50 will be subtracted from the group receivables and group what? Payables. In the books of S, the amount due to H was shown as 40. So when you check S to H, it is 50. But here they are saying in the books of S, the amount was 40. Why? Because S had sent a check for 10 million, but H had not recorded the check. All other balances were in agreement. So intergroup debt, there is intergroup debt, which is, yes, that is not 6. Intergroup debt is how much? 40. The correct balance is 40, not 50. Because there is cash in what? Cash in transit of how much? 10. There is this other side. They had already sent a check of 10. There is only a problem that they are not for depreciation. Are we not considering the year it was sold? Yes, it was sold in 2010. So the profit was recognized in that year, 2010, but depreciation affects every year. You know, depreciation is charged every year, so we consider it very much. Very good. Number 7. The group uses the full goodwill method. We have done those full. All the dividends and interest have been paid by the end of the year. That is a very great concern to me. You know, when you pay dividends, especially when the investee companies are paying dividends, S, A, and J, when they pay dividends, those dividends are recorded by the parent as intergroup investment income. So should we have investment income under in the P&L, they should be subtracted. Whatever income you got from within, when it comes to dividends, associates and joint ventures are now deemed to be part of the family. So I need to know what is called intergroup investment. Intergroup investment income. Intergroup investment income. When we talk of interest and dividends, those are just investment income. So they are saying these people are already paid dividends and interest. So I need to know how much dividends was paid by S, by A, and by J. They should be eliminated during consolidation. So dividends. So dividends paid by SAJ. SAJ. S paid dividends of how much? Check P&L. Check P&L. Check P&L. The income statement. When you check income statement keenly, are you able to see dividends? Kindly check to confirm. Check to confirm. The dividends, yes. Is there dividends paid? How much? Yes, I can see people giving me 50, 30, 60. It is 50, 30, 60. It is 50, 30, 40. 50, 30, 40. So these are what this company is paying. So parents, so of these dividends to parent must have taken 80 in S. They must have taken 40 in A and 50 in J. So 80% of 50 is 40. 40 of 30 is 12. 50 of 40 is 20. So total intercompany dividends, which came from your own investment, is 40 plus 12 plus 20, which is 72. Then interest, also there is interest. Interest is quite not very clear, you need to be keen. Check the small note before note 2. Check the small additional information before note number 2. H also invested in a half of the 10% loan stock. When you invest in loan stock, what are you expecting in return? Interest. But now you see the interest in this case is interest which you are getting from one of your own internally. In fact, to make it very serious, it's from the nuclear family. You know, nuclear family is H and S. So the interest which H received from S should be eliminated. It is not considered to be part of income. So they invested in a half of the loan stock. So go to the non-current liabilities, check what was the loan stock of S. Parent invested in a half of it. Non-current liabilities of S, sorry. How much? I'm seeing 200. Yeah, so parent invested in a half of that 200. So tentatively parent invested in 100. So of that 100, they were receiving interest at what rate? 10%. So internally, from S, parent got interest of 10. So intergroup interest is 10. Therefore, the total intergroup investment income, which should be eliminated, which came internally, sums up to how much? 82. It sums up to 82. So that is all. We can now do a question. We can now do presentation of P&L. Let's do presentation of P&L. So right there, H group. H group. H group. Consolidated. Consolidated statement of profit stock loss. for the year ended when? Thomas, year is ending on? But first December.
30th April.
30th April, eh?
Yeah.
30th April 2012. Correct? Shillings are in?
Millions.
Millions. So have that with one column so that we start consolidation. So we have collected all the evidence. So we can start consolidation now. So let's stick to their P&L from top down. Top down P&L, income statement, we have revenue. So revenue. Just in case someone is joining now, we are doing question 2 of the handout, the June 2012. So you will get these other ones from someone who sent Thomas as usual. Then you can just kick off from here. So revenue, like Wanjala, you have joined late. One page. All right. So revenue, we add, but now you add H and S. H and S. Don't consolidate for A and J. Are we together? Yes. Thomas, are you together?
Yes.
Because
they are
not part of nuclear family. They are associates. We don't have control. Anything 50% and below, we don't have control, and therefore we don't need to consolidate for them. So you take here 12 plus what? 12 plus 6 minus intergroup sales. Whatever was sold between parent and subsidiary. That was captured in note number 3. If you check note 3, sales from H to S, 100. So minus 100. Minus 100. Huh? 17. 100 is in the group sales. Then I've not subtracted the sale of PPE because I told you the other question, you need to subtract even if it is sale of PPE. But here the PPE was sold in 2010. So, you know, profit account is 1 year off. Yes, so it was those years, so we don't subtract. So this is 17. Then we go to cost of sales. We go to cost of sales. Cost of sales, you add 650 plus 250. So I explained to you last time, so I will not explain. Now again, you minus the intergroup sales, then you add unrealized profit risk to reduce it to cost of sales. So minus 100, then you add back UPI. The unrealized profit, when you add it here, it will reduce the minus 100 to minus 80 what? 5. So 85 is the cost. So we add UPI to reduce the sales to cost of sales. Then don't forget about depreciation. These people were charging excess depreciation every year by shillings how much? 8. They were charging excess depreciation by 8 every year. Whether said or not, depreciation, unless otherwise they say depreciation should be classified under cost of sales. So they were charging excess and classifying in cost of sales. So you subtract. I said minus the sales plus unrealized profit to reduce the sales value of 100 to what? To cost. So the cost will be minus 85. So what is the entire value? 807. Therefore, gross profit will be how much? 17 minus 807. What do you get? 893. Then proceed with their format. Investment income. Investment income. So investment income, add the 2, 85 plus 2 minus intergroup. There is intercompany investment income. This one here, the one we have just calculated, the total came to 82. So what remains is what came from outside. Adam, what is the issue? We don't multiply by the years, no. P&L you don't accumulate. The number of years you accumulate in the balance sheet. Balance sheet is where you subtract accumulated depreciation. Profit account, you charge depreciation for that particular year. You know P&L is, okay, good. How much? 5. Then before I proceed with their P&L, associate and joint ventures should come here once. And even if we are not having control, we have some interest. We have 40%. You cannot underrate 40%. You cannot underrate 50%. So the profit they make, we must take our share of that profit, then we share here. So you say share of profit after tax in associates, and also in where? Joint ventures. In associates and also in joint ventures. So associates, go to the P&L, check how much is their profit after tax. Parent normally goes for that net profit. So you don't, because they said you are others, you take back seats, wait for them to operate the whole year. Once they make their profit, they tell you how much is your share. So I'll take 40%, I'll take 50%, times the profit they made immediately after tax. So check P&L, immediately after tax, income tax, A made 71, this one's made 341. I hope you are able to see the figures. Sure. So can you share 40% of 70, 71, confirm if it is 28.4, 341, 50, that is 55.5. Can you confirm? Then that one I don't know. 80. Can you confirm? The accuracy of the figures, don't copy, because I'm being guided by Holy Spirit. Because I've got it. So then then proceed with their schedule. So this one is always a free tip to a student who has not panicked. Distribution costs. You add distribution cost 100 plus 40. This one always has no working, so that is 140. Please let me caution you, and I caution you highly. There's a group of students, I don't know, they don't like negative things. They get the answers. You see, like this one is something easy. But instead of bracketing the expenses, they just leave the answers positive. If you do that, you will come for another fellowship next semester, I assure you. Even if the answer is correct, but you fail, please, I know you might say that I have ever seen. So if we have someone like that, then God has sent me to you to rectify this very early. In expenses, please have the spirit of bracketing them. We proceed. Admin 120 plus 90. But impairment is classified as administrative. Check where we calculated goodwill. Total impairment, I recall, we got 21. So can you add the 3? That is 210 plus 21 is 231. So 231. Bring the next finance cost. Finance cost, you add 40 plus 20. But there was intercompany interest. You know, finance cost is the group of interest. Eh? Actually, mostly finance cost is considered to be what? Interest. And even you can recall this one here. Let me show you. This one here. Parent invested in a half. Another 200 loan stock of S. That is what they are multiplying. 200 times 10%. And they are showing us how much? 20. But parent invested in what? A half. So it means of the 20 they are paying, a half is being taken by parent. So a half of that interest is called intercompany what? Interest. So what S has paid of 20, a half of the 20 is going to the parent company. So you subtract. I hope you have understood that. So this is intercompany interest. That is 50. Can you help me now with the profit before tax? So start from 893, adjust up to down there. Can you do that very fast? Do that, chap, chap. What do we get? Somebody? So how much? 560? 560.9. Yeah, many people are getting the same. 560.9. Bring income tax. Income tax. You add the two. Add the two. The two is 60 plus 50. 60 plus 50 is 110. Therefore, PAT is 450.9. It normally ends there. Then you share. Franco. All right, so how much is the, so down there you say profit attributable to noisemakers, NCI, and also holding company. And once they share, you will comfortably come back to 450.9. So have an outside working for PAT to NCI. So PAT, that is your working, PAT to noisemakers, PAT to NCI. PAT to NCI. So NCI, PAT of the subsidiary, that is the one they take. And I've been singing that, and I will continue singing. Minority only takes the profit share in the subsidiary. You know, you cannot give them the percentage of consolidated, because consolidated, parent brought theirs plus subsidiary. Where they meet, minority only meets with the parent in the subsidiary. So they share the profit after tax of the subsidiary, not consolidated. If you give them percentage of consolidated, then you will be quite unfair to the parent, because parent is standalone. You know, consolidated is brought by parent and subsidiary. So where they have a share is in the subsidiary. So NCI always takes their percentage of PAT in the subsidiary. So PAT of S Limited PAT of S Limited. Check their profit account. Check their profit account. So when you check the profit account, you realize profit of subsidiary is 150 what? Are you seeing the 152? The income statement, the profit immediately after tax for the subsidiary, 152. Then I would have subtracted UPI if the sale was upstream, meaning S the user. But in this case, H is the one who sold. UPI affects the profit of the seller. And here the seller was H. So the profit of S is not affected. But if S is the one who sold, then their profit will be affected. So that one ignore. They were charging excess depreciation. You add back. Add excess depreciation. Every year, they were charging excess by how much, Thomas? They were charging excess by 8. So add back. Then this was full method. Full method means NCI participated in goodwill computation. So they participate in goodwill. They are also liable for what? They are liable for what? Impairment. It will affect the profits here. Impairment in the subsidiary was 5. Check your books well. So those are the only items you adjust. Actually, when it comes to PAT of the subsidiary, you check 3 items. UPI, but UPI on one condition, that is upstream. Upstream means the subsidiary is the one who sold to the parent. Impairment also has a condition.
So you less.
Yes, you less. Impairment also has a condition that it was full method of consolidation. Full method means in goodwill computation, we consider the fair value of NCI. Otherwise, if it is partial, you don't subtract. Then you check the asset which was being depreciated by the subsidiary. As simple as that. So I'm adding back excess depreciation because excess must have reduced the profit. How much is the adjusted PAT? So you say adjusted PAT, adjusted PAT 155. Therefore, noisemakers will take 20%. Remember, parent was controlling what percentage? To 80. So that is 31. So back to our P&L, minority goes with 31. So the parent will take 450.9 minus 31. So tell me what is going to the parent. One? 419. 419.9. You need 5 ticks here. If you get 5 ticks, you get those 10 marks. So can you gauge yourself? You check how many you can get. You as you, not you and others. You and the 13 others. All right. You press on now. All right, so now I want us to go to the balance sheet, consolidated balance sheet, but I have a request. That balance sheet, there are some workings. So I rather we do them first. Then once we start, we just complete. There are some workings there which will just make our life very difficult. On the side of the assets, associate and joint ventures comes once in the balance sheet. what do you consider? You check how much is your investment. Because ukiinvest KQ, say 40 years to come, kama uliweka hapo 200,000, bado itapata 200. No, either iende juu ama irudi chini, depending with the performance. So when we are doing consolidation, we are being told to ignore associates and also to ignore joint ventures. But we cannot ignore even our money which we invested in that company. So you need to tell us how much is our current investment. And that investment we will capture in the balance sheet. And it comes once. So allow us to work out the current investment in associate and also current investment in joint ventures. We will not move without those elements. So have a working there. Investment in associates. Can I combine them? Yes, I can. Associates and joint ventures. For purposes of time, we can combine them. Those ones will not even move. So we can have here A, we have here J. Not sure, but it can. So what was the initial investment? Initial investment. How much did we initially invest in those companies? Check note 1, the purchase, something purchase, whatever. In note 1, additional information number 1. In additional information number 1, initial investment in A, parent invested 200, parent invested how much? 250. I hope you can see the figures. Initially they invested 200 and also they invested 250. Then any post-acquisition reserve which will come up, parent will top up with their percentage. So right here, add post-acquisition, profits, post-acquisition profits. So in A, post-acquisition profit will be 40%. How do we get post? Yes, Thomas? The initial investment, check note 1. The 200 and the 250 was the initial investment. Check additional information number 1. They purchase, I don't know, they called it purchase what? Cost of purchase. Yes. So now next time to my handout, try to print. It becomes easier. And even those ones will get lost. You will end up having answers without questions. So it's good to print and have some bank of so you'll see the 200, the 250. Any profit which they made after acquisition, you will top up. So how do you get the post-acquisition profit? You go to the balance sheet. You know balance sheet is today. Balance sheet is today. Opening retained earnings and close retained earnings. Correct. So you go to the balance sheet to get the post, go to the closing retained earnings in the balance sheet. For A, under equity, are you seeing the retained earnings of A of 200? Yes. Check under equity, there is retained earnings of A of 200 minus the retained earnings which was there since we acquired, when we acquired that company. Check note 1. That additional information number 1. When that company was acquired, A, their retained earnings was 100 and what? 50. So the difference is what they have made since acquisition. So you take 200 minus 150, then you take 40%. What do you get? 20. Then in B, in J, you will take 50%. The same thing. The same thing. The same thing. The closing retained earnings. Closing retained earnings is how much? 280, true. Minus when we acquired J, 120. 120. So that is 280, 120. That is 160, 50, 80. So here you capture 80. Also, there was revaluation. Revaluation is part of reserves. So you also take revaluation. Revaluation A, 40. J, 50. The same thing we have done. The closing minus acquisition. Closing minus acquisition. So closing revaluation in A, 50. Closing revaluation in J, 50. Minus, minus. On acquisition, in note 1. In note 1 on acquisition, 1520. 50 minus 15 is 35. 40 of 35 is 14. 50 minus 20 is 30. 30 by 50 is 15. So now, these people should be telling us that our investment is 234. This one should be telling us that their investment now is 345. However, their investments were impaired. There was impairment loss in their goodwill. So it will affect their investment. Unakumbuka ile siku watu walikuwa, there's a time KQ walikuwa na a lot of issues. Mpaka customers hawakuwa wanapanda hizo ndege. So everybody was saying, KQ, no, we can't use that one even when you're pandani. We cannot use that one. So that shift, the customer shift, is a negative goodwill. Is an adverse. Yes, it's an adverse goodwill, which is what? Impairment. So everybody will be affected. So they can do it on pro rata basis. We have been affected to what extent? Kila mtu anabear that negative cost. So that negative cost will reduce. If you want to go and withdraw your investment, then they will calculate that negative effect, which is impairment. So go back where we calculated goodwill. You tell me the goodwill of A and J were impaired by how much? So you cannot just tell us. So impairment loss, I remember this was 8.5, if I'm accurate. Sure. Yes. And this was 7.5. True. Impairment loss, the 25% of the goodwill. Yes. So the net investment right now, which we will take in our balance sheet as an asset, will be 234 minus 8.5, 22.5, 345 by 75. You need to consider 337.5. That is what you take to the balance sheet. Other working which we need to check on is revaluation. Is revaluation. Is revaluation. Can you check the balance sheet? I want to know the total consolidated revaluation. In the balance sheet, revaluation for H, bring all of them. For H, revaluation is 200. For SAJ, you will take post-acquisition because The pre-acquisition are also part of the closing, and they were already taken for goodwill computation. So any reserve, and please, whenever I'm talking of reserve, I'm talking of retained earnings and revaluation. Whenever you need them, anywhere you will need them, after acquisition, you go for post. Post means what is appearing in the balance sheet minus on acquisition. So for S, I'll go for 80%. In the balance sheet, revaluation is reading 50. So you take 50 minus, on acquisition, revaluation was 20. So 50 minus 20 is 30. 80% of that is 24. Then in A and J, I'm not going to struggle. They are here. This one's 14 and 15. Those are what the parent takes. 14, 15, which you can even show if you want. The 40, the 50. The 50 minus 15, the 50 minus 20. Therefore, total consolidated revaluation is 200 plus 24. That is 224 plus 29, 253. Check to confirm. So, we are remaining with the two workings. Then we do that balance sheet. So the two workings, NCI and retained earnings. So let's start with NCI. Let's start with the computation of NCI. Let's start with computation of NCI. Balance sheet, Sasa. So NCI's equity. You can call it NCI's equity. We want to know the capital of noisemakers. So, what was their fair value when they were acquired? That was their capital on that date. Fair value on acquisition. It was mentioned in additional information number 2. Sure. Yes. Check additional information number 2. Check additional information number 2. So number 2, the fair value of noisemakers on acquisition was 70 what? 75. Then, you know, minority are in the subsidiary. Any profit which will come after acquisition, they will take 20%. Then they increase their capital. So you had post-acquisition profit. Any profit subsidiary made after acquisition, give minority 20%. They were controlling 20% in that company. So post-acquisition retained earnings in S. Check the closing. Closing is balance sheet minus of the date of acquisition. So balance sheet retained earnings from S. Are you seeing 375? Retained earnings of S in the balance sheet. Then on acquisition, additional information number 1, you should be able to see 85. So 375 minus 85, that is to 90, 20%. Is that 58?
Yes.
Yes, that is 58. Then what else will affect these noisemakers? Revaluation. They will ask you for revaluation. You add post-acquisition revaluation, they will bring you problems. 20% in bracket. Check revaluation closing. Closing revaluation is 50 in the books of S, minus on the date of acquisition in note 1, that is 20.
Yes.
Yes, a little bit less. 20. 50 minus 20 is 30. 20% of that is 6. Unafikia sijui hizi vitu? Then what? What will affect these people? UPI will have affected, but S is not the one who sold out. But there is excess depreciation. You add back excess depreciation. So Adam, for balance sheet purposes, now depreciation will bring accumulated. Hey, everyone to take note of that. When was this asset sold? Check note 4, additional information number 4. Usually 2010. So 2010, 2011, 1. 2011, 2012, where we are, how many years? 2. So they have charged excess depreciation for 2 years. So balance sheet, depreciation is to be accumulated. P&L, depreciation we just take for each year. So that one, they will take 20%. Excess was 8 per year. But they have charged for how many years? 2 years. So 8 times 2, 16. 20% of 16 should be 3.2. Yes, should be 3.2. You add back. Impairment. There was impairment loss. You less, it will affect them. So impairment loss, impairment, I remember it was 5 in the books of S. In the books of S, impairment was 5. So minority will take 20% of that 5. And it ends there. 20% of 5 is how much? 1. Therefore, the total equity of minority shareholders, that is 133.6, 9 plus 3161 minus that, 141.2. Correct. Very good. Then we finish with retained earnings. Then we can do our balance sheet now. In exam, ukienda na hii style, utaanguka mapema na asubuhi. Here, I'm doing this because we need to balance it at the end of the day. In exam, is there need for balancing? No. So I don't encourage these workings in exam. I'm doing them because this one is a potential question. They tell students to calculate the investment in associate or in joint venture. So you need to know how it is done. If it is not required, thou shalt not waste your time. Be smart. You know, we have in that exam, we have a student sitting for a fact and the student sitting for a fact. So which one do you want to be? Yeah, hizi bana hizi matakataka hapa mingi kwa mtihani. You ignore, utakuja kufanya ukiwa mwalimu. Tuende kwa retained earnings. Unajua sasa unasema kwa roho, kwa nini tulimwambia tunataka kuwa mwalimu? Hata sisi tulijikuta hapa. Tulijikuta na kuna training. So naona kama Wanjala atakuwa mwalimu. Akiwa na Mary Kananga pia anaweza kuwa mwalimu. Hata Alan. Soma sana wewe. Lakini I know here we have some teachers. Felix. Let's get retained earnings here. Retained earnings. That is the last one. So retained earnings, consolidated. We want to get consolidated retained earnings. Consolidated retained earnings. That is what we want to get. That's the speed. That's spirit. Alright, so shillings are in millions. You bring H. Can you tell me the we can't take that direction? we'll go the statement of changes in equity style. So retained earnings brought down for HSAJ. Then we add retained earnings for the year. Usilete a minority, you bring for parent. Then you less dividends. Dividends paid by the parent. Hizo zingine zinaletwa kama intergroup income. So this one, relax. If we get this, we move very fast. Indio naona itatuwestia time. Check for me P&L, their profit account. How much dividends did the parent pay? For these other companies, we don't treat kama investment income to katoa. So we always go for parent only. For parent paid dividends what hour? Are you seeing the 50? Yes. Remove the 50. Then consolidated profit for the year is this one here. This one. The profit which went to the parent. That is the consolidated profit for the year. So take it there. 419.9. Then we want to know how much was the profit at the beginning. You know it is beginning plus during minus the dividends. So beginning, can you check profits brought forward in the income statement? The last item in the income statement they gave us. Are you seeing for J? Let me start with J. Retained profit brought forward for J. Are you seeing 209? So you will take 50% of 209, but you subtract what was there on the date of acquisition. What was there on the date of acquisition? Because that brought forward includes what was there at the time we acquired them a long time ago. Because this is brought down in the year 2012. But the company was acquired back, I don't know in which year, in 2010. So what was their retained earnings by that time? 120. So you take 209, you subtract 120, then you give us 50%. What do you get? 44.5. You can bring it here, somewhere here, not to the far end, somewhere here. Then A, the same thing, 40, you take brought down minus pre-acquisition. Pre-acquisition has been taken in goodwill computation, so you ignore. So how much is there brought forward? This 159. Yeah. You see 159 brought forward for A. Yes.
Yes.
159 minus on acquisition, additional information number 1. How much was it? 150. So 159 minus 150, 9. 40% of 9 is 3.6. Then we go to S, 80%. But S nitakuwa na vita na wao kidogo. Brought forward, they have given us 273. Check 273. Minus on acquisition. On acquisition, where is acquisition of S? 85. Minus 85. The problem I have with S, you know, S was charging excess depreciation every year. And what is profit brought forward? Profit brought forward is the profit for the prior financial periods. And in prior means, and in that last year, 2010-2011, they charged excess of 8. It means the last year's profit, which is being brought down this year, was understated by how much? 8. So you add excess depreciation. They undercharged by 8. They were charging excess depreciation. So you don't accumulate for 2 years. You include this year. But you see, brought down is from last year up to the start of this year. So brought down was multiply by 2. You know, by 2 is this year inclusive.
So this date is for the other year.
Yes, the brought forward is for the other year, which is being from that year to. Yes. So it.
Why minus?
Excess depreciation we add.
What is excess?
Excess means they had reduced the profit.
Yes.
So the profit was understated. So you add back. So get that. So God is our. What do you get? 156.8. H. Check. Brought down for H. Brought down for H. Brought down for H is how much?
445.
445. However, last year is 2010-2011. CHD waliuzia hiyo asset S at a profit of how much? Remember UPFA of 40? Yes, they are the people who had sold at a profit. Please indicate in your books, this is UPFA, this is excess depreciation. Otherwise, you can look for them until you become tired. Then you conclude that any moment you are doing retained earnings brought forward for parent, you subtract 40. So that is 45. But to get the total brought down, so that we get the total figure. So total brought down comes to 609.9. 419,950, you get 979.8. Confirm, then we start our balance sheet. This one inakuwa inatishia watu. Simekubali. Ndio inajifanyanga hiyo ishi. Leo tumeshikia chini. Sawa. All right, you're getting the same so that we start consolidation, the balance sheet. Someone can just confirm whether the answers are perfectly okay. Kuna kizungu kama perfectly okay? Yes, they have confirmed. Right there, H group. Consolidated statement of financial position. So H group wanafanya hapo katikati. Yeah. Are you ready? All right. We start. We copy their balance sheet. Let's copy their balance sheet as we consolidate. Let's copy their balance sheet as we consolidate. So their balance sheet, non-current assets. Thomas, be there? Non-current assets, top down. Top down, PPE, so property, plant and equipment, 1250 plus 800 minus UPFA. You remember UPFA of 40? Right? You subtract the UPFA from the assets. Then they were charging excess depreciation, 8, but they have charged it for how many years? 20. That answer correct? So 1250 by 800 minus 40 plus 16 must be correct. So 8 times 2 years is excess depreciation. So you add it back because they have understated the assets for 2 good years. Next item, intangible assets. Intangible assets, no problem, unless you create a problem. Intangible assets, you add 200 plus 120. That is 320. Investments. That is investment you have to be keen. Investment have 3. What if they invested in subsidiary, associate, joint venture? Investment in subsidiary, you don't bring it in consolidation. That is family investment. So you replace it with goodwill. So, what you invested in the subsidiary, you replace with what? Goodwill. I remember, goodwill in S was 20, but there was an impairment of how much? 5. Thomas, you also remember?
Yes.
Yes, there was impairment of 5. So the goodwill of S 15. But for A and J, you don't bring goodwill. You bring your current investment, which you are adjusted. So investment in associates, we got 225.5. Joint venture, we got 3 what? It was 337.5. Come on. Investment in joint venture. How much was it? 337. 337.5. So the total investment in these small companies is 563. Therefore, you will give us this total here. Can you add? Investment in the subsidiary is replaced with the goodwill. Yes, we don't bring investment in subsidiary. Instead, we bring goodwill. Take note of that. So how much? Somebody? That total, Adam, 2924. 2924. Current assets, inventory. Inventory. So inventory, you take 200 plus 75. That is 275. Hey, where? Minus what? UPI. Minus UPI. I almost went straight. Minus UPI. UPI was how much? Their realized profit was 15. So that one should give us 260. This is UPI, the unrealized profit on stock. It was 15. Receivables. Receivables. I hope everyone is there. Receivables, we add 300 plus 90 minus intergroup debts. Unakumbuka intergroup debts tulisema ni 40. 40, but there was cash in transit of how much? 10. Ile check walisema ilikuwa imeandikwa. So this is the intergroup debts. This is cash in transit. Unatoa bado kwa receivables because they have already been paid. No, the intergroup debt was 50, but they said if the other side it was 40 because they had sent a check of 10. Yeah, so the correct balance is 40, but there is cash in transit of 10. So that is 390 minus that, 340. Then financial assets. Financial assets, you just add 30 plus 20, 50. Cash, 150 plus 40 plus cash in transit. 10 is the cash in transit, you add it to the cash book. Kindly. 200. Therefore, give me the total assets. Total assets will be how much? That is 294 plus, well, that is 3774. Check to confirm. No, but see, so 260 plus 340 is 600. 600 plus 250 is 850. 850 plus. See, labda you are unabembeleza figures. Equity and liabilities. Wow. Equity and liabilities. Proceed na hiyo yao. Ordinary share capital, parent only. Sio unajua? Treating every Kenya. Ordinary share capital, parent only. I explained, and we are not saying it again. There is the rationale behind it. You always take parent only. Ukiona do ordinary and share premium, parent only. 3 mark, 1,000. Alafu unaenda kwa mtihani. Ni wapi tulikuwa tunachukua kwa parent only? Unajua kuna parent only lakini hujui ni wapi. You want, but there's a reason, but I can repeat. The reason is for subsidiary, okay, you know, tentatively associate and joint venture, we don't want them. For subsidiary, parents took their percentage when they were calculating goodwill, and even NCI took theirs. So for subsidiaries share, yes, parent wanachukua yao wakitafuta goodwill, NCI wanachukua the balance. So that's why we take parent only, but you don't go into those reasoning. Parent only. Share premium. Share premium. We don't have time to reason a lot. Share premium ni ngapi? 300. Revaluation reserve. Revaluation reserve. We have just done a working here. Can you check to confirm? But I remember it was around 253. Check to confirm. Confirm very fast. 253. Then there is retained earnings. Retained earnings. Retained earnings, we have also done a working here, and we got 970 what? It is 979.8. It's still here. Once I Kananga, 979.8. We also got, you must tell minority their capital, otherwise they will bring you a lot of issues. We got 141.2. Yes, we got 141.2. Therefore, can you add? How much is the total equity? $26.74. Non-current liabilities. So go to non-current liabilities. 10% loan stock. 10% loan stock. Loan stock 400 plus 200 minus 100. I'm subtracting 100 because examiner said parent invested in a half of the 200. So that a half is called intergroup loan.
Si parent wanasema wali invest in half of the 200. So 200 is a intergroup loan stock. So hiyo tunatoa. That is why I'm subtracting the 100, the half of the 200. That is 500. Deferred tax. That one has no working unless you want to bring workings for it. 100 plus 50. How much is that? 150. Current liabilities. Payables. Payables 250 plus 200 minus intergroup debt. Debt the correct debt was 40. Because walikuwa shalipa 10. The correct intergroup balance. Yes, yes, it's 40. So that's what you subtract. Don't bring cash here. They have already paid. So you don't capture that. This is 450 minus 40. 410. Yes. Then current tax. No working, you add 20 plus 20. That is 40. Can you confirm whether it will balance with our total assets? So this is total equity and liabilities. Can you check whether it is in agreement? So means 37. Correct. I've never thought this question can be finished within 2 hours. What do you mean, Maisha Raka? Another 2 hours, Jaisha. We still even have 30 minutes. So it means that will be 6:15 in the Maliza. Huh? I was calculating for myself. Now, that question is over. I want to remind you again. Could I remind you again? No, I want to remind you. Whichever it is. In group accounting, in this level, I told you the other day we have what is called what? Normal. There is what is called step. There is discontinued. Discontinued, which some people call disposal. There is foreign. There is cash flow. There are those 5. This is the group. The group as a topic in this class. There are this ones here. This one is reserved. You can number yake. So this one is reserved. 20 marks. Then of these 4, they alternate. They bring this, next time they bring this, they bring this, they bring this. So what we have been doing normal. Normal means not step, not discontinued, not foreign. And as a result, whatever we have been doing was more or less of what we did in section 3, financial reporting. There is nothing advanced. So what makes this group to be advanced group is this 3. Advanced means new concept which you have never came across around from section 3. So these are what makes it to be ideally advanced. That one does not mean that they don't examine normal. They do so many times. They do. They do. So one will check. I stopped, but if I were to say the high chances is here, normal and discontinued. But I don't want to venture into those. To be safe, not everything. So, all right. So from here is now when we are starting the advanced group. What we are doing was warm up of what we did the other side. So write for me a subtopic. Step, stroke, piecemeal. Piecemeal acquisition. Step, stroke, piecemeal acquisition. Step, stroke, piecemeal acquisition. So
step stroke piecemeal acquisition. Actually, that is the one they examined last semester. That is the one they brought last semester, and does not mean they can't bring it again. They can. In fact, very well. In fact, 20 marks. So I've said to be safe, you just know all of them. So right there and say, no, I'll explain, right and say. It is a business combination. It is a business combination. It is a business combination in which the investor obtains control. Business combination in which the investor is who? Parent. Investor obtains control over the investee, through multiple transactions. Full stop. Another hyphen. After gaining additional shareholdings, comma, the parent needs to remeasure the investment previously held. To its current fair value. Full stop. Another hyphen. Goodwill should therefore be determined. After the step acquisition. Full stop. Hata kuna story mingi hapa. Goodwill should therefore be determined after the step acquisition. Full stop. Kuna story mingi. What happens is simple. Take it to serious. The parent maybe was having 40%. When the year started in January, which is going to December, from January up to around April, the parent was having 40% in that company. 40% it was associate. Then kufika hapa, wakatop up 20%. Inakuwa what percentage? 60. So you see from this date going forward, that company is what? A subsidiary. But when they were controlling 40, it was being accounted for as what? Associate. So our question will be, how do you consolidate for a company where the parent has topped up additional shareholdings? It was associate or it was a joint venture. Then along the way they topped up. It has become a subsidiary. How do you go about the books? It was a subsidiary, we were controlling 60, they top up 20, 80. What happens? It was a subsidiary, it is still a subsidiary. What will happen during consolidation? So step acquisition or piecemeal is whereby the parent gains additional shareholdings in the investee company. So how do you adjust that in the financial statements? So what happens is nothing serious. An example illustration. Right, the illustration. So in your illustrations, though we are not doing now, illustrations, just a minute. Right there, May 2019, question 2. May 2019, question 2. Right there, August 2022. August 2022, that is last sitting. August 2022, question 1. Question number 1. Then right there, May 2021. May 2021. Question number 1. So those are the only step questions you have in the entire past paper. It is new. It was brought the other day, 2018. They have examined it 3 times. I'll try as possible if we can solve 2. But if we can do 1 tomorrow, 1 the other class, then we move to the other one. Otherwise, do have a nice what? What do you think, Mary? Sawa, what do you think? Miss, you come your recording, you go up, but I'll check. Should we be starting at your 6? Should we be starting at 6? You want a 6? Huh? Should we be starting at 6? Because you see when we are finished in good time. Assuming work days, someone can get sufficient time even to rush.
The next question.
We will see as time goes by. But now I 6 because by now a job becomes quite convenient. Thank you. We'll progress. Let's meet at 6 p.m. For step acquisition. Don't miss. Thank you.